All right, let's jump straight into this. Welcome to today's Explainer, where we're going to unpack a truly fascinating, really high-stakes game of territorial strategy. Just imagine for a second that you're a financial architect, and you've been tasked with scaling an industrial or export-oriented enterprise in an emerging market, let's say Tajikistan. Now, your job here isn't just basic accounting anymore. It's about fundamentally optimizing the entire corporate tax burden. So how do you actually do it? How do you scale this enterprise while legally shielding its profits and operations from standard taxation? Well, what's the definitive answer? What is the absolute ultimate weapon for institutional tax optimization in a scenario like this? It's establishing residency within a free economic zone, or FEZ, like FEZ Sughd or FEZ Dangara. Honestly, this is the holy grail for a corporate treasury. But as we're going to see today, wielding this weapon requires a level of operational discipline that most organizations are simply not prepared for. Section 1. The ultimate tax weapon. To truly understand this weapon, we've got to define what exactly we're dealing with when we talk about a free economic zone. You know, a free economic zone isn't just some industrial park where you rent a warehouse and get to work. It's a legally segregated fiscal territory. Think of it like a fiscal fortress surrounded by a moat, operating as a legal offshore environment right inside the country's own borders. This setup gives corporations absolutely unprecedented advantages. We're talking massive tax holidays and zero-rated customs tariffs. But here's the catch. Those state-granted privileges, they are highly conditional. Operating inside this fiscal territory demands extreme operational discipline from your enterprise. Part 2. Anatomy of the Fiscal Oasis. So why on earth would a state offer such incredible benefits? Simply put, it's to attract foreign direct investment and stimulate industrial manufacturing. If your enterprise manages to secure resident status, just look at the absolute fiscal shield your corporate treasury gets to wield. First off, a 0% corporate profit tax. All commercial profits generated from activities within the zone, completely exempt from standard corporate income taxes. Then you've got 0% import VAT and customs duties. That means when you're importing heavy industrial machinery for your capital expenditures or raw materials from abroad directly into the FEZ, you pay absolutely zero customs duties and zero import VAT. And on top of all that, residents are entirely exempt from municipal real estate and land taxes, and they're even shielded from traditional turnover-based road infrastructure taxes. It's just a brilliant, comprehensive shield for your commercial operations. But there's a crucial catch here. It's what we call the human capital exception. While the corporate and customs taxes virtually vanish, your mandatory labor taxes definitely do not. The enterprise is not exempt from the human element of taxation. An FEZ resident still has to meticulously calculate and remit the personal income tax withheld from employees, as well as the mandatory employer social tax. You have got to keep this distinction perfectly clear in your ledger. Section 3. The Territorial Paradox. Now, this paradox is probably the single greatest misunderstanding for C-level executives when they first enter an FEZ, and it centers entirely around an invisible customs border. See, for customs purposes, the FEZ is literally treated as foreign territory. This creates two totally different scenarios. First, you have the export advantage. If your FEZ Sughd factory imports raw materials from China tax-free, processes them into finished goods, and exports them directly to Uzbekistan or Russia, that entire supply chain remains completely tax-free. It is incredibly lucrative. But then, look at the domestic market trap. If you decide to sell those exact same finished goods into the domestic Tajik market, like say shipping them to a distributor in the capital, Dushanbe, that transaction is legally classified as an international import into Tajikistan. The distributor in Dushanbe actually has to clear those goods through customs and pay the standard 14% import VAT plus any applicable duties before those goods can even enter the domestic economy. Because of this trap, a financial architect absolutely cannot use the FEZ as a tax-free backdoor to just flood the domestic market. It literally doesn't work that way under the law. You are forced to strategically build entirely distinct pricing models. You need one model for international export, which gets to enjoy that beautiful tax-free margin, and a completely separate model for domestic distribution, which has to be a customs-adjusted margin to account for that 14% import VAT. Section 4. The Revocation Trap. All right, so we've talked about the incredible benefits, but what happens if you fail to maintain absolute compliance? You fall straight into what's known as the Revocation Trap. The privilege of FOZ's resident status is granted through a severely strict investment agreement. To even get a seat at the table, a corporation has to commit to specific investment thresholds. For manufacturing, that minimum threshold is $500,000. You have to deploy this capital, and you must adhere to strict operational timelines. The stakes are incredibly real from day one. If you violate the rules of the zone, the Ministry of Economic Development and the FEZ administration will mercilessly initiate a status revocation. So what actually triggers this? Well, treating the FEZ as a mere shell company rather than a legitimate operational base, failing to deploy that promised capital on the agreed-upon timelines, or, and this is the absolute worst one, attempting to smuggle raw materials out of the FEZ and into the domestic market without proper customs clearance. And right here is where the trap snaps shut. The penalty for losing your resident status isn't just that you have to start paying taxes moving forward. No, it's a catastrophic retroactive penalty. Under statutory law, if your status is revoked, your tax holidays are annulled from day one. The tax committee will audit your enterprise all the way back to its very first day of operation. They will forcefully assess all of those standard corporate profit taxes, import VAT, and customs duties that you thought were previously exempted. And to make matters even worse, those assessments are compounded with devastating late payment penalties. Make absolutely no mistake here, a revocation event is functionally equivalent to corporate bankruptcy. It will absolutely destroy the enterprise. The sheer financial weight of years of retroactive taxes and penalties is simply way too massive for almost any treasury to survive. Section 5. ERP Fiscal Segregation. Okay, so how do we protect the corporate treasury from this kind of existential threat? We need a structural, technological solution to avoid what we call tax contamination. For enterprise conglomerates operating both a standard domestic company in Dushanbe and an FEZ factory in Sughd, the absolute best solution is deploying Odoo ERP's Multi-Company Architecture. Let's walk through the 3 critical steps for this. Step 1 is database segregation. The CFO creates 2 entirely distinct legal entities within a single Odoo database. Step 2 is automated fiscal positions. You program Odoo so the FEZ company uses a custom FEZ tax engine with 0 rated VAT and 0 profit tax, while the Dushanbe company remains strictly on the general tax regime. And step 3 is handling intercompany transactions. When the FEZ factory sells to the Dushanbe distributor, Odoo automatically generates an intercompany sales order and a corresponding purchase order. And honestly, this is the magic of the whole system. Odoo treats that intercompany transaction exactly as it is legally defined, a cross-border import. It automatically applies that 14% import VAT strictly on the domestic Dushanbe company's ledger. By doing this, you are perfectly simulating the physical customs border with unshakable digital operational discipline. The financial architect uses the system to secure maximum tax efficiency while entirely eliminating the audit risks associated with the FEZ Revocation Trap. Which leaves us with this final critical thought to ponder. If you're operating, or planning to operate, in an environment as lucrative but dangerous as a free economic zone, is your corporate architecture structurally prepared to survive the revocation trap? Mastering territorial taxation isn't just about knowing the law, it's about embedding that law flawlessly into your technological infrastructure. Thank you so much for joining me for this explainer, and I really hope this gives you a powerful new perspective on the mechanics of global tax strategy.